In today's market update, I'm going to be taking a look at gold and what a Hurst cycles analysis tells us to expect for this precious metal. While you're taking a look at the disclaimers and making sure that you understand them, I would like to point out an interesting thing about gold. There is a conception that is held by many people that when stock market prices decline, gold prices will rise because gold is considered to be a safe haven for people trying to escape the stock markets. In fact, if you look at the correlation between gold and stock market prices historically, this doesn't really hold to be true, but nevertheless it's an interesting concept that many people still accept. And I find it interesting that gold has been our most requested instrument at a time when the stock markets are generally in the process of turning down, as we've discussed in previous updates. So I think that's a really interesting little observation, but let's take a look at the price of gold and speak about what is happening. So here is an analysis of gold. I'm working with a nominal model that consists of shorter cycles. This is a nominal model created by the late John Eastreich, who was a very experienced and very talented gold analyst using Hurst cycles, and he came up with this nominal model, and we discussed it in a webinar that I held with him in late 2015, in which he explained how he came up with the nominal model. So I'm not going to speak too much about it now, but effectively the cycles are all slightly shorter. So we have a 7.5-year cycle instead of a 9-year cycle, and so forth, all the way down the nominal model. Gold is a really very interesting instrument for a Hurst cycles analyst. Hurst dedicated an entire chapter or section of the Hurst cycles course to a discussion of gold. And he suggested that gold is influenced by cycles that have a different wavelength to the cycles that influence stock markets. He suggested that those cycles probably have longer wavelengths. And some people have asked me, why is it that the nominal model that I work with, which is John Eastreich's model, has shorter cycles, whereas Hurst actually mentioned working with longer cycles? And the answer surprises many people. It's because, in fact, they are one and the same. Because of the nominal model that we work with is a list of harmonically related cycles. If you want to change your cycles to work with longer cycles, then in fact you're often doing very much the same thing as if you are working with a nominal model that has shorter cycles. And the reason for that is because it is a harmonically complete model. So for instance, the 40-week cycle, if you're working with a shorter cycle, as we are here, is a 30-week cycle in your analysis. If you were working with longer cycles, then the 20-week cycle would also become a 30-week cycle. So in both nominal models, you're working with a 30-week cycle. So I hope that makes sense. It doesn't really make much difference whether you work with longer cycles or with shorter cycles. You very often end up with effectively the same nominal model. So this is the analysis that I have for gold. We have data going back to 1985. I've started the analysis, as you can see, in 1999. And this is the analysis that we discussed in the webinars that I did with John in 2015. The sort of really important points to notice are that we had a 7.5-year cycle trough in 1999, another one in 2008, and then a further one in 2015. Those were the low points. And in fact, the discussion with the webinar that I did with John in late 2015 was about the approaching really important 7.5-year cycle trough. So you can take a look at that webinar. It was an excellent forewarning of that low point in the price of gold. The other thing to notice is that, of course, I have a peak analysis up at the top of the chart, and the important thing here is that we had a 7.5-year cycle peak in 2011. And you can see this rather messy nest of highs over here tells us to expect another 7.5-year cycle peak, probably roughly towards the end of 2019. So let's zoom in on this chart and take a look at a little more detail. So let's first of all take a look at the trough analysis, because most people start by considering a trough analysis. It's most familiar kind of analysis, and let's measure some distances between these troughs from the 7.5-year cycle trough towards the end of 2015. You see we have 54.5 weeks up to the trough in December of 2016, and then we have a 20-month cycle that elapsed to the trough in August of this year. So 14 plus 20, or 13 plus 20, gives us 33 months roughly. So that's a slightly awkward length of time. I mentioned that I'm using a slightly different nominal model here, and so I'm using longer cycles, and in fact the 18-month cycle that we're used to looking at in markets in this particular nominal model is a 22-month cycle. And so looking at this analysis, you can see that the positioning of the troughs is really not very good. Sentient Trader wants to put the 22-month cycle trough over there, and this big trough here is only a 40-week cycle trough, and the analysis just looks a bit sort of broken up in terms of troughs. One of the interesting features of this particular nominal model that John Eastreich built is that the harmonic ratio between the 22-month cycle and the 45-month cycle is only 2 to 1. Now, in a normal nominal model, we work with a harmonic ratio of 3 to 1, because we have 3 18-month cycles for every 54-month cycle. So perhaps part of the problem with the trough analysis is caused by the fact that we have an unusual harmonic ratio of 2 to 1 instead of 3 to 1. So I'm going to just very quickly show you an alternative chart, although I'm trying not to show too many alternates in these market updates. Let's turn off that composite model line. But here is a similar analysis, but working with a 14-month cycle, which is this yellow cycle over here. And you can see there Sentient Trader has found the first 14-month cycle trough, and here is the second 14-month cycle trough over here in December of 2017. And this trough here that occurred in August is being phased as only a 40-week cycle trough. So this is an analysis or a nominal model that has a 3 to 1 harmonic ratio between the yellow cycle and the orange cycle, or the 14-month and the 42-month cycle in this particular case. So you can see that according to this analysis, we need 3 of these yellow cycles, 1, 2, 3. And so the big trough that is being expected according to the trough analysis is in March, April, or early 2019. And if we switch back to the other analysis, you can see that we have a really rather staggered nest of lows over there, but we have a similar expectation in many ways, particularly if you focus on the yellow cycle over there, which is that we're going to be experiencing a big trough in early 2019. So according to this analysis, the expectation would seem to be that the market is bouncing out of a 40-week cycle trough. It's going to form a 40-week cycle peak over there, and then it's going to come down and it's going to form a really big trough over there. But now we need to consider how important the trough analysis is. As I've mentioned, gold is an instrument that I believe is influenced by cycles that are synchronized at their peaks. And very often, a trough analysis on gold can be very misleading, because those troughs are not always synchronized. Sometimes they are, particularly with the really big troughs, such as the 7.5-year cycle trough in late 2015. That was a synchronized trough, but not all troughs are synchronized, and so it can really be very misleading. So what we should rather do, in my opinion, is focus on the peak analysis. So what are the peaks telling us? Well, we're looking at the price of gold coming into a 40-week cycle peak fairly soon, and here is the really big peak. It's also a very staggered nest of highs here, but that's the really important peak. Now, if you're not familiar with studying nests of highs and nests of lows and understanding what they mean, then we have the very useful tool of the composite model line. And so let me display the composite model line. Now I'm only showing cycles from 22 months up to 7.5 years. So this is a really sort of big picture composite model line. I'm not adding too much detail at this point. But you can see that the composite model line has been revealing the basic structure of the market, up, then down, then up, then down. But now the market came a lot further down than the composite model line indicated it was expected to do. Why was that? Well, a very useful thing that we can do with the composite model line is that we can build a composite model line out of both the trough and peak analysis, or out of only one or the other. So let me show you what happens to this composite model line when I do not include the troughs. Here is the composite model line based only on the peaks. So you can see this composite model line actually follows the price action a lot more closely, particularly in recent times. This indicates that the peak analysis is giving us a better understanding of what the market is doing. It doesn't necessarily mean the peak analysis is correct and the trough analysis is incorrect. What it means is that the way in which the cycles that are synchronized at their peaks are influencing the markets gives us a better idea of what has actually happened in the market than by looking at the trough analysis or working with the cycles that are synchronized at their troughs. So let's add in, let's zoom in a little further, and let's add in the 40-week cycle into this analysis, and the shorter 24-week cycle perhaps, and let's even come down to there. There we go. All right, so I pointed out a little earlier that we have this big nest of highs over here, and here in the composite model line you can see what that nest of highs is expected to do. Price is expected to climb in to form this 40-week cycle peak, and then it's expected to come down again. Okay, and in fact what I should really do, let me clear that, and let me just turn off the trough phasing, because when you're only considering a composite model line built out of one analysis, it's much better really just to focus on that analysis. So we're looking at the market coming up to the 40-week cycle peak over here, then it's going to come down, and then it's going to move up strongly into this peak, which is expected in late 2019, which is going to be the next really big 7.5-year cycle peak. So the bottom line is that the peak analysis is telling us that the market's expected to rise up at probably into the end of this year, then come down, but not too much, and then climb up really quite high into the end of 2019 for its really big cycle peak. Now let's see what happens when we include the trough analysis again in our composite model line, and let's show the trough analysis at the foot of the chart. There we go, and we'll include it in our composite model line. There you can see a composite model line that, as I've already mentioned, doesn't really match the price action nearly as well as the peak only analysis, indicating that the peaks are probably dominant. But you can see that the basic structure of the composite model line, in other words, the direction that it is moving and roughly when it is turning, does follow the basic structure of price. So you can look at that without me drawing lines all over it. But our expectation when we are also including the trough analysis is indeed for a peak still to form over here, which is let's see where that is. That's in about early December of this year. Then price is going to come down. It's not going to come down very far. And why is it not going to come down very far? Because that peak analysis, this huge peak that we're expecting at the end of 2019, is acting like a magnet on price, and it is pulling that price upwards. So this is the expectation if we combine both analyses. Let's do one final exercise, and let's exclude the peaks from this composite model line. Now this is when we see a really big difference in the shape of the composite model line and what we are expecting. You can see that we are still expecting price to rise up into about December of this year. Then we're expecting price to come down, And here is that little trough that we saw earlier. But then, as you can see, the price of gold begins to falter, and it forms a lower trough, which is this big nest of lows over here. It's a 45-month cycle trough, and that trough is going to form in, let's say, August, September of 2019, before the price of gold goes up. So those are the expectations. As I have mentioned several times now, I believe that the peak analysis is most probably the analysis that we need to be watching. But the interesting thing about these composite model lines is that their structure is really quite similar. So let me draw the expectation according to that composite model line, and let me see if I can then change it and select include peaks again, and there we go. And now let me compare those two composite model lines, and let me change the color for this comparison. So here, this yellow line, you can see is giving us an upward moving market to roughly the same kind of time. Then we get a downward moving market to roughly the same kind of time. Then we get an upward moving market. And this is where there is a discrepancy between these two analyses, because if we consider the peaks, we would expect a stronger upward move over here in about May, June of next year. Then they're going to go back in sync, and both of these analyses show us a trough forming over here in about August of next year, followed by a strong move up. So you can see it doesn't really matter which analysis we're looking at. In terms of the structure, in terms of the direction of the move, we're getting very similar expectations. So as we're watching the market action unfold, we're not going to be able to choose between these two analyses very soon. The first point of time at which we're going to be able to say, yes, definitely the peak analysis is proving to be the better one, is going to be, and let me change the color again, it's going to be this period of time over here, because if the price of gold starts failing and starts dropping down, then it would seem that the troughs have become more dominant. Otherwise, of course, we will be relying on our peaks to carry price up to a really good high 7.5-year cycle peak towards the end of next year. And so let's just go all the way back out again, and there you can see the composite model line, and let me just simplify it slightly just as a quick conclusion. There you can see the composite model line, and this is the composite model line constructed out of both troughs and peaks, and you can see the rise of price up into the 7.5-year cycle peak. And if we make this a peak only composite model line, which in my opinion is probably a slightly better analysis, then you can see that is the expectation that we have. I do hope that you found this market update useful, and that it helps you to gain an understanding of what we're expecting in terms of the gold price according to a Hurst cycles analysis.